Good morning or afternoon, everybody, depending which coast you're on. We're going to go ahead and get started in about a minute. We are letting everybody come in from the waiting room. We'll go ahead and get started to honor the people who showed up right on time. Thank you for that. And thank you for joining us for the third in our 2024 webinar series. You will be able to use the question feature, Q&A feature on your toolbar. If you have questions, go ahead and put them in as we go through. We'll make sure that we have time to answer them at the end. And if we don't get to your questions, we'll provide written response in the follow-up to our webinar. I'm joined today by our ecosystem partners, Bob Dahl, Chief Executive Officer and Chief Investment Officer of Crossmark Global Investments. Bob is a sought-after strategist who is often featured on Bloomberg TV, CNBC, Fox Business News, and Faith and Finance Live Radio. And from SDR Ventures, a boutique investment bank dedicated to helping entrepreneurs capitalize on their life's work and legacy, we have SDR's Managing Director, Scott Mitchell. Scott has a long history of successfully working with founders and family business owners at the point of a transaction. And I'm Dr. Allie Taylor, a co-founder of our family business, Conveyance Solutions, and a business psychologist and co-founder of Orange Kiwi. That's my passion, a firm dedicated to helping low to mid-market owners navigate significant transitions. Speaking of transitions, our country is about to go through a presidential election. And we've heard the word unprecedented many times, so I'm not going to use that today. But hopefully what we'll experience is the peaceful transfer of power. It's safe to say that the country and perhaps the world is holding its collective breath to see what will happen in this election. As business owners, getting the upper hand amidst the volatile, uncertain, complex, and ambiguous, or as the term goes, VUCA environment we're facing involves understanding the past, appreciating the present, and preparing for the future by creating as many options as possible for our businesses, our families, and ourselves. And when I think about the things outside of our family business that we must proactively prepare for, it's oftentimes we prepare for the worst and hope for the best because we have little ability to control many of the forces that impact us. Forces such as the socio-political, regulatory, investment, and economic environments. And these forces often remind me of natural disasters like hurricanes. They don't happen very often, but when they do, you better pay attention. And more specifically, I'm drawn to the spaghetti models that predict the hurricane track, intensity, and impact. The farther away we are, both in geographic distance and time, the more potential paths exist and the broader the cone of certainty. But as the hurricane gets closer to a particular location, the prediction models are increasingly accurate. The earlier the people in those potential paths take notice and prepare, the more options and opportunities they have for putting themselves, their business, and their family in the best position for navigating the impact of the storm before, during, and after it hits. And that's where we find ourselves today. The cone of certainty is getting narrower, but we don't yet know where the hurricane's going to hit. And so our goal today is to understand the current reality, explore opportunities to gain the upper hand, and consider the steps that we can all take. Let's start with Bob's economic update. Bob, can you give us an update on the economy since our last webinar and the investment markets, and maybe discuss the historical impacts of past elections, and maybe we can look at some long-term trends.
Great, thanks, Allie. Hi, everybody. Let me start with a couple comments about the election before moving into the slide pack. Markets tend not to pay attention to elections until about Labor Day, largely because elections are uncertain. And even we had certainty, we're not sure exactly how you would impact your portfolios as a result of the elections, because politicians are not articulate about what they're going to do. And a lot of what they articulate about, they just want to talk about and won't end up doing anyway. Having said that, there are firms that created a Donald Trump portfolio and a Joe Biden portfolio. And needless to say, prior to the debate and the switch on the part of the Democrats, the Trump portfolio was doing well and the Biden portfolio wasn't. Once the change was made, obviously now there are Harris portfolios. They look similar to, but not identical to the Biden portfolio. And those, along with the betting market odds, are basically saying it's a coin toss, we don't know. And therefore, I think making moves in the stock market because of the election is a fool's game. So with that conclusion in view, let me say it's the market as a whole, there are more uncertainties than usual. In an investment committee meeting yesterday, I summarized what's changed. One, stock market had roughly 10% decline and a 10% recovery. We're back to where we started. Two, the uncertainty of the election has risen, and that creates additional uncertainty overall, and markets don't like uncertainty. Three, we've completed second quarter earnings, and they were quite good. And yet, on the other hand, the third quarter earnings estimates and forward 12 estimates have fallen. Now, how do we interpret that? I.e., more confusion. So I'm not going to go through every item on this slide, simply to say, if you were a bull, you could get behind a podium and make a very cogent argument. And then you go backstage and change and put your bear suit on and come out and make the other case, and you could be equally convincing. There are all kinds of variables floating around. Let me comment on a couple. The Fed, the Central Bank of the United States, has started and is likely to continue to signal that in September's meeting they will lower rates for the first time in a very long time, and probably signal further cuts to come, as the calculus has changed from fighting inflation to now fighting economic weakness. Inflation has fallen noticeably, but as you can see in the second item here, most people on the bearish side are saying we're not going to get to 2% inflation. I am in that camp. Without a recession, we will not get to 2% inflation. We have to live with something closer to 3%. So the Fed changing its course, inflation making a lot of progress. My problem is earnings and valuation for the stock market. I've expressed this in our calls before, if any of you've been on before. Earnings expectations are very high. The consensus is that corporate America will produce double-digit earnings growth this year and next year. Back-to-back has never happened in U.S. history, absent recovery from a recession. So you can guess my doubt that we're going to achieve those. Valuation, I don't know how you value stocks. There are lots of ways. Price to earnings, price to cash flow, et cetera, et cetera. All of them are in the upper decile of history. Doesn't mean stocks have to go down. It just says the risk is reasonably high. Next slide, please, Becky. So a couple of comments about the fact the economy is slowing. I could take my entire time on this. Let me just make a couple of points. Inventory levels are rising and employment statistics are weakening. That's a bad combination. Doesn't mean we're going to have a recession. It almost guarantees, however, the economy will slow. And of course, if you follow these things, you can get confused because one week the numbers are not so good. The next week, oh, they're okay again, et cetera, et cetera. My view is we will continue to slow down because of the long lags between what central banks and others have done to economic weakness. Next slide. I've shown this slide in our episodes before. It basically says how long from the time the Fed first raises rates to fight inflation, which this time was the first quarter of 2022, to the onset of a recession. And the answer is on average 10 quarters. We're in quarter 11. So if we're going to have a recession, this is not late. This is very normal. The dialogue always is Fed raises rates. We better get scared. We're going to have a recession. Then we don't get one and people get complacent, which is where people are now. And then when we least expect it, a recession hits. Will that happen again? Well, it would be a following of history. The Fed has tried to engineer a soft landing 7 times, and they have failed 5 times and succeeded only 2. So if you're playing the odds, you would bet we're probably going to have a mild recession. Next slide. Here's the earnings comment I made earlier. To get to those double-digit earnings guesses, we need the fourth quarter of this year to show 18% earnings gain. We never get 18% earnings growth unless we're annualizing post a recession, which we didn't have 4 quarters ago. So I think the numbers will continue. They already started to come down. Next slide. This is my sober up slide if you need one. It looks at history. There's no projection on this slide. It's all history. It says, what's the starting valuation of the United States stock market as represented by the price earnings ratio, the PE ratio? That's the left column. The PE ratio today is 23 times. So we concern ourselves with the bottom row. Historically, when PEs are this high, what happens in the next 1, 3, 5, and 10-year period? Answer, on average, stocks go up 4, 5, and 3% per annum, including dividends. That's my best guess. I know you all have great financial advisors, and you're expecting those advisors to continue to give you double-digit gains in your stock portfolio. My blunt response, good luck. We're starting at very high valuations with inflated profit margins. Hard to see us getting there. Doesn't mean you can't make money in the stock market, but it's probably going to get tougher from here. Next slide. And of course, we've had, and many of you are very well aware of the concentration in the stock market. The first 6 months of this year, the S&P 500 was up 15%. But 9 of that 15, 889 basis points to be precise, came from just 5 companies, with half of that coming from NVIDIA all by itself. This is not sustainable, and the market, thankfully, has begun to broaden. Next slide. Fed raised rates, I remind you. Now I'm going back in history, just a few quarters, from 0 to 5.25% 18 months, the biggest ever in the shortest amount of time. There are consequences to that, and we've not seen them all yet. We've had interest rates, I'm rounding to be dramatic, essentially 0 for about a decade. That will go in the history books as a mistake. Too many people got too much cheap money to go too many speculative investments. Some of them will go bad, and that's coupled with the high and rising federal budget deficit and galloping higher federal interest expense, which will soon eclipse defense as the largest piece of the U.S. budget. These things are just not sustainable. Predicting when they hit the fan is impossible to tell, but we've got a reckoning to come. Next slide. Here are the election issues. I hope we get around to debating them at some point in time. So far, it's been, I'm a good guy, you're a bad guy, and the opponent says, no, I'm the good guy, you're the bad guy. And you know what I'm saying when I say that. We've got to get to these issues. Please, let's get there so we can have a legitimate debate for both sides' sake and for our sake. End of editorial comment. Next slide. So what is the broad agenda of these two parties? It's pretty explicit. The Democratic one is pretty similar, whether it's Joe Biden or Kamala Harris. Corporate taxes are going to go up. There'll be higher taxes on anyone earning more than $400,000. The child credit will expand, perhaps significantly. We'll have a bunch more spending on climate change, and there'll be more regulation, especially around drug prices. Should Donald Trump be elected, we will see higher tariffs, especially on Chinese goods. There'll be an extension of the tax cuts, probably for everybody, low, medium, and high income people. There'll be more energy production. You've heard the phrase drill, baby, drill. There'll be a restraint on illegal immigration. And day one, there'll be deregulation to try to free up the economy to move at a faster pace. These are very different agendas. To repeat, I hope the candidates get out there and talk about these so we can understand the differences and how strongly they feel about them. And this will set the agenda for markets once some of this legislation comes in place, not before. Next slide. So, to confuse you and to provide history, what's happened when we've had a unified government, that is the White House, the House, and the Senate, all the same party, or divided government? The answer is not a whole lot of difference. If you look at it race by race and year by year, you can see when there are various combinations of White House, Senate, and House, and you see numbers that are different one from another. But the key is, are we going to have growth incentives and lower inflation, or the absence of growth and higher inflation? That will determine the stock market, regardless of all the fancy programs. Next slide. So I already comment on this, but I wanted to just see the picture. It shows in the orangish color net interest outlays, that is interest expense, and how it's growing as a percentage of federal spending. And blue, defense spending, it's going up too, but just at a slower pace. Hard to believe we're going to have the orange outlast and outshine the blue. Next, which I think is my last slide, some conclusions. I've touched on some of these, but let me rifle through them and then I'll pass the baton. We think that in the next 6 to 12 months, a mild recession will commence. The inflation will fall a little bit further, but fail to meet the 2% target. The Fed will lower rates, but less than expected. Remember, at the beginning of the year, markets were expecting the Fed to lower rates 6 times in calendar 2024. Earnings will fall short of expectations, even if we don't have this recession. Stocks are expensive. Be very selective in what you own. Focus on earnings predictability, earnings persistence, and cash flow. Do some dollar cost averaging international. I find lots of Americans who have almost none of their investments overseas. That's been the right thing to do in the rearview mirror. Not sure it's exactly the right thing going forward, especially if number 8, we get some dollar weakness, and then geopolitical and election cross currents that I'm sure we will have more to say about in the minutes that remain and maybe in your questions. So let me pass the baton.
Thanks, Bob. As always, incredible insights. So how do founders and entrepreneurs translate this information into a relevant so what for their business? I find it interesting that in the last 2 elections, Scott, let me have you comment on deal volumes and valuations and what happens.
Thanks, Allie. Really appreciate that. The last 2 election cycles, we really have seen deal volumes and valuations rise immediately following the elections. When Trump shocked the world in 2016's election, there was enthusiasm from the business community around a pro-business administration. And this did have a real, if modest, positive impact on deal making and valuations. In just a minute, we'll look at a specific case study to demonstrate this point. And then when Democrats took back control of the executive branch in 2020 with the Biden election, a complete opposite reaction from the business community actually led to an even more dramatic uplift in deals. There was a 124% year-over-year increase in deals that occurred as fear of rising corporate and high net worth taxes took hold. And so as we look at those impacts and we try to forecast forward, the truth is that those increases in M&A activity were much more sentiment driven than policy driven. And to reiterate the counterintuitive reality, both positive and negative post-election sentiment led to an increase in M&A activity, and the negative post-election sentiment led to a higher increase in M&A activity. Policy change ultimately did not shift as much as the sentiment may have indicated, because we continued to have, as Bob mentioned, a divided government where no one party controlled Congress and the executive branch. And so in order for significant policy changes to take hold, we'll likely need a unified government led by one party. So with that, what lessons might we apply as we approach the 2024 elections? So looking at this heat map, we know that the election landscape for control of the presidency, Senate, and House are all really, really close races and may ultimately come down to a handful of districts in a couple of states. And by no means are we on this call the right folks to forecast the results of any of these races. That said, this graphic would demonstrate that the path to House control may be slightly clearer for the Republicans than the Democrats. And then if we look over at the map for the Senate, the heat map demonstrates really this is a neck and neck race. This is, akin to the men's 100-meter final we just had in the Olympics, which came down to Noah Lyles winning in a photo finish. And in fact, at the finish line, if you remember, the announcers actually called it wrong at the finish line. And ultimately, the results were different than what the announcers even said in the moment. So this could be one such race. So perhaps the takeaway here is that a continued divided government with no party controlling the executive, Senate, and House is still the most likely scenario. If there is a path toward a full control and a unified government, the more likely outcome looks like a red wave rather than a blue wave today. This table here shows the policy tendencies that Bob talked about earlier in a bit more detail among each party. And these are policies that really could impact founders and entrepreneurs as the elections shake out. Trump's agenda really includes maintaining and extending many of the tax cuts he was able to enact in the 2017 Tax Cuts and Jobs Act. This includes renewing a bunch of tax cuts that are about to expire for estate taxes and individual income taxes. And we can know that at a bare minimum, Harris will support letting those cuts expire naturally in the given timeframes. We can also bet that a Harris victory will mean more legislative attempts to support green energy and deepen environmental regulation, while a Trump victory will certainly have domestic fossil fuel companies excited. And so if Harris wins, this will likely elevate the opportunities for any companies that operate in the regulatory space, compliance services, especially in the financial and environmental markets. Perhaps just as a side note, the one area where bipartisan support exists is in crushing TikTok and increasing oversight in AI and social media. So with that, want to do a look back and give you guys a couple of specific examples how elections impacted middle market deal making. So again, the sentiment from the election may influence M&A activity more than actual policy, at least in the short term as we look into 2025. And here are a couple examples of how this played out recently. So when we'll look first at when Trump was elected in 2016. SDR was representing a major client, Vans, in the heavy equipment yellow iron rental industry. Think renting bulldozers and excavators for construction projects. We first engaged with Vans in 2014 to help them sell the company. And Vans rented a lot of its equipment into the oil and gas industry. In 2014, there was a major downturn in the oil and gas industry, and that caused prospective buyers to stand down on an acquisition. So SDR worked with the Vans management team. We just called timeout on the M&A process at that time and just decided, hey, let's monitor macro conditions until we see signs of improvement. So as we fast forward to 2016 and valuation multiples in the equipment rental industry were holding steady at right around 5 times earnings, as reflected in this chart, which is United Rentals, the largest public company in this industry. And then once the news of the Trump victory hit in November, almost like a light switch, multiples in this industry shot up to 6x plus. And so SDR immediately recognized this change in the macro environment, and the Vans team agreed that it was the right time to approach the buyer market. So long story short, in early 2017, Vans closed a transaction with Sunbelt Rentals on terms that were significantly more favorable than those prior to the election. And so now let's transition and examine another case study following the Biden election. This case study is for Dunn Plumbing, a leading residential plumbing and HVAC company in the Denver metro area. Toward the end of 2020, the owners of Dunn became aware of a significant roll-up in the private equity space relating to plumbing and HVAC. And the owners were intrigued, but also cognizant that they had a lot of growth they still wanted to capture before considering selling the business. However, as with many sellers during that time, the owners of Dunn were concerned that the Biden administration would raise taxes and significantly decrease their net proceeds in a sale. And so the sellers decided to engage SDR to help them sell the company in April of 2021 with the goal of closing a transaction prior to year end, when it was considered most likely that would be the cutoff for tax changes to go into effect. And so just 4 months later, in August 2021, Dunn went under LOI with Radiant Plumbing, who promised a 45-day close to make sure that we were well within that year-end timeframe. Just to be clear, that's about half the amount of time it normally takes to close a transaction. And so then we're rolling along just 2 weeks before the deal was scheduled to close on September 13th. The House Dems finally proposed raising the long-term cap gains rate from 20% to 28.8%. And their initial proposal said it would be effective starting on that day, September 13th. So I still remember it was a crazy day for us. And so even though we were a couple of weeks out closing the deal, there was a mad scramble to see if we could somehow represent the deal as closing on that specific day. Long story short, there was not an opportunity to do that. And the deal closed on September 29th. And the reality was the tax increase proposal never went anywhere. And so this is just, again, a demonstration that sentiment drove the desire to do a deal. And by the way, it turned out to be a fantastic deal for the sellers, but the anticipated policy never actually materialized.
That is a great point, Scott. While we don't have crystal balls, which would have been nice in that case, And we cannot know if there's going to be a red wave, a blue wave, or no wave at all. I think what we're collectively saying is that we're well served as family business owners or business owners in general by considering the impact of a Democratic versus a Republican administration, as well as what dominant parties may control House and Senate. So we think about planning, decision-making, and human behavior. Current research indicates that people who have already played out scenarios in their mind and know how they're going to respond across the range of possible outcomes have a greater sense of control and resilience when things actually play out. So what this comes down to is challenging what you think you know, because we're all subject to a lot of biases and can become very complacent at this point in time. And we're far less in control of our decision making than we realize. Our brains are primed by algorithms in our social media channels and the news outlets we choose to watch. And our default is to integrate the ideas that we agree with and dismiss those that we do not. And this is probably the greatest area of risk, in my opinion, as a business psychologist in the current environment. For example, when the scale gives us a number, we jump on the scale in the morning and we like the number, we're down a few pounds, that's fantastic. We move on with our day and feel pretty great about ourselves. But when we don't like the number, maybe it's a couple pounds higher than we would like, we might move the scale to a slightly different location, jump on, jump off, trying to get confirmation that our desired outcome is the reality. And there's multiple behavioral economic studies that have demonstrated that our approach to checking our 401k, for example, the number of times we click or open our account, when things are favorable, we check it often. We get a dopamine hit. And when they're not, we avoid looking at the hard facts, not wanting to force ourselves to acknowledge losses or feeling overwhelmed like we can't change it anyway. We're hardwired to seek dopamine and avoid cortisol. So they take the path of least resistance and avoid emotional labor. They're protective mechanisms, but they're not going to serve us very well today. And so the counterbalance is really to build margins of safety in your business, for your family, within your own mind, by choosing to consider the worst case scenarios. Get rid of that confirmation bias as you start to plan for the best. So boards of family businesses need to be really great thinking partners, or any business need to be really great thinking partners and challenging biases as they plan for the worst and think about the best, because reality is usually somewhere in the middle. So what steps can you take concretely along that line of thinking? Worst case scenario, plan for higher taxes in the business environment and build your cash reserves in the business. 3 is review your investment portfolio to ensure it's appropriately diversified and considerate of your risk tolerance level. Bob highlighted that very few Americans are diversifying and investing overseas. Maybe you want to talk to your financial advisor about whether that makes sense going forward. 4, if you're considering an exit in the next 1 to 5 years through sale or family succession, or maybe a combination of the two, explore your options as early as possible. Get a market evaluation. Define your goals for mom, that's management, ownership, money, and yourself and your family. Evaluate the gap that needs to be closed between where you are and what you need to do to reach your goals, and create a plan. That's a long-term process. No matter what happens with the election, you need to be going through that process and thinking long-term will enable you to make better decisions when the election outcomes are known. And the 5th one, remain calm and don't panic. People make the worst decisions when they're in panic mode. As Scott did a great job of helping his clients not panic and try to slow down and make a wise decision that paid off well for them. That's a great example. Finally, remember Albert Einstein's recommendation. Out of clutter, find simplicity. From discord, find the harmony. And in the middle of difficulty lies opportunity. No matter what happens after the election, opportunity will exist. And business owners are very creative. If we put the right team in place to help us make great decisions, no matter what happens in November, there's going to be opportunity for those who adapt quickly. With that, I'd like to open it up to Q&A. And Becky, can you run through any of the questions that might have come in. And while you're doing that, I've got a couple of questions that came up as you guys were sharing. Scott, this is for you. How would the Fed's rate cut impact M&A activity in the lower end of the middle market?
Yeah, really good question. We've talked about this before. Deal making was way down in 2023 in conjunction with a rise in rates and really with a conjunction of a pullback in the credit markets. Deposits were down. We know about the SVB collapse, right? And so the credit markets really pulled back in 2023 and into 2024 in terms of helping finance transactions. And I always say that credit is the grease that makes the private equity wheels go. And so, we've seen that lenders are starting to help finance deals again, even now, as we know that rates are very unlikely to go up from here. But I do think that for things to really loosen, again, from a sentiment perspective, even if it's, a quarter of a percentage point, a rate cut will have a positive impact on increasing deal flow and sort of making deals more possible.
Fantastic. Becky, what do you have for us?
Yeah, a couple of them came in. This one is for Bob and Scott. Maybe Bob, you can kick us off. I know Bob and Scott talked about this, but can you add a bit more color on the impact of the election on TCJA?
Look, I think there's going to be a lot of back and forth in terms of not just who's the next president, but what does Congress look like, as Scott clearly pointed out. And that will have an impact on whether that gets kept, eliminated, modified, and therefore we don't necessarily know what's going to happen, which is always the case before elections. You just don't quite know. So I'm not going to go out on a limb. Scott, do you want to?
Yeah, I'll take one example, right? There's a big sort of estate tax cliff coming up at the end of 2025, where basically the tax cuts had increased the amount of income income level, right, to $27.6 million, I believe, for a married couple, where you were sort of free from estate tax considerations. If that cut expires, it'll cut in half, back down like by 50%. And so I guess it's anyone's guess. I would say that it would take, the most likely scenario is it would take a unified Republican government to keep those, to extend those estate tax cuts. It is probably the reality, so that those cliffs that are coming in 2025 more likely than not, I would guess would expire.
And I would add, under almost any circumstance, I'm sure you're going to agree, Scott, it won't be retroactive. So you will be able to do things in 2025 that you might not otherwise do if it were extended.
Right.
And so just to be clear, the TCJA, Tax Cut and Jobs Act, Scott, what you just talked about was tying it to the estate tax. There's a provision in there that has a higher cap on the estate tax that's transferable without penalty or without taxation. And then over that limit, if it decreases in 2026, then people would have less that they are exempt from and more that they have to pay tax on if they were to exit their business, just to put it in simple terms. Is that an accurate understanding?
yes, the exemption will go down.
Awesome. What else do you have for us, Becky?
How might market volatility surrounding the election impact business valuations or financing options?
Go ahead, Scott.
Yeah, I think you know, we touched on that, and it is, you know, the reality is it's going to be kind of industry specific, right? But the uncertainty caused by the election causes a little bit of you know, people to freeze, and then once the election happens, that creates some more certainty. And so as we discussed earlier, that is why, at least in the last two cycles, and again, you know, it's always you know, you go with caution when you have two data points and you're trying to pull a trend line, right? But we have seen deal making activity go up again, no matter who wins, because for opposite reasons. And so, you know, at least in the private markets, could we see, you know, activity and valuations rise? I think that's a distinct possibility. But again, it will be somewhat industry specific.
Awesome. If we are planning on a liquidity event, is there a benefit to doing it before the election, after the election? How does investing before or after the election change?
I'll start and Scott can follow up as he likes. The election only will tell us who the winners and losers are, and therefore the likely direction of legislation and legislative changes. It does not mean on election day, that is, whether it's a Republican or Democrat running the show, as it were, that the policies will change. You will have time because they have to enact legislation over a period of time. So you've got time. Now, of course, there can be instantaneous reactions in markets to valuation levels and interest rates, but they tend to be small relative to the legislative impacts of the changes that will occur regardless, depending on who's installed as the new president in Congress.
Yeah, I don't have much to add. I would say, if you haven't started your liquidity event journey, you will not have that happen before the election. But even if you have, I don't think the election is going to, you know, have an imminent impact on, you know, whether you care if that deal closes in 2024 by year end or 2025.
Great. And then the last question we have, Scott, if you can tackle this. What is the current sentiment among buyers and sellers? Are other business owners or potential buyers hesitant due to the election?
Yeah, I would say in the last 90 days, we've seen activity start to really, again, pick up in the M&A markets. You know, both sellers and buyers coming out of the woodwork after a slow 2023 and you know, first half of 2024. I would still say one thing that we've talked about previously is this idea of flight to quality, and the fact that buyers are still very concentrated in really investing in and looking at those, what we would call A assets. You know, if you know, B or C is an average asset, we really see buyers paying up even greater premiums for really high quality assets, and then those you know, maybe more average to marginal businesses really not getting as much attention as they might have a couple of years ago. So that's a reality. And the fact that private equity fundraising has definitely been down. They have a lot of capital they need to deploy, but fundraising has been difficult. That probably won't impact deals in the next year or two, but certainly the fundraising could have a longer term impact. So all that to say is, the highest quality businesses, valuations are as strong as ever and as marketable as ever. If your business doesn't grade out that way, and oh, by the way, we have surveys to help you figure that out, then you might have some work to do to make it really attractive.
As we close out and come to our last couple of minutes, Bob, one of the things that I know owners really care about, or one of the things where they get stuck when they're thinking about generational success or the sale of their business, is values, and tying their values to where they put their money, where they put their time and activities. Can you talk a little bit about how people can think about investing from a values-based perspective?
Sure. I'd start by saying that's what we at Crossmark spend most of our time doing. About 75% of the assets we manage for individuals and institutions is values oriented. Everybody has different values. And the question is, do you want to line up your life, including your investments, with your values? If the answer is yes, then you got to go on a little bit of a search to say, well, exactly what are my values and how do I implement them in my portfolio? One of the predictions when I did that at the beginning of the year is that values-based investing will take an increasing share of assets under management in 2024 for the 8th year in a row. So it's a growing part of the asset management business as more and more individuals, financial advisors, and institutions are looking to line up their investments with their values. And there are two parts to that. One is, what do I not want to own? Because these companies are doing bad, damaging people, killing people, products that kill people. And on the other hand, and more interestingly, okay, what are the companies that are doing good? Who's improving the world? Their employee base, their customers, their community, et cetera. And there are a lot of ways to measure that. So you need to find somebody who's in the values space to talk to try to figure that out for yourself and where you line up. But it's an increasing hobby and of a lot of people.
Absolutely. And Scott, I think you see concerns around values alignment when somebody's going towards a transaction. Can you talk a little bit about how you help owners think about values in alignment with potential buyers?
Yeah, absolutely. And it's an underappreciated concern that folks have, and it's really kind of legacy, right? And how you built the business and the principles that you've operated under. And a buyer comes to you with an offer and it looks like a good price and good terms, but is it really consistent with what you've built and your own desires after the deal, right? We say a deal is just a chapter in the story of the entrepreneur and the business. And so we find that most founders and entrepreneurs really do want to see their business continue to thrive and succeed in the teams that will remain with that business. And so we spend a lot of time talking about creating a menu of options for business owners that reflects the 3 C's: the consideration, the certainty of close, and then the post-close legacy and ongoing next chapter.
Fantastic. It's been a pleasure to do this webinar series with you. It'll be interesting to see what the outcome of the election is. And no matter what happens, I think 3 of us agree that there will be opportunity for those who are agile and alert enough to find it. Agree? Awesome.
You said it.
All right. Thank you, everybody, for joining us. We'll have the deck and the recording out to you by the end of the week via email. I'm Allie Taylor. Have a great day.